Hello, welcome to the Mutual Fund Show. My name is Niraj Shah, and I think uh, I think what we're trying to do today is pick up two key things and try and talk about them. One is on the positive side. Everybody is wanting to invest in gold. Now, out here, we are not making a judgment call about whether investing in gold is right or wrong. What we are trying to do by this show that if you want to use mutual funds, are they a good investment vehicle for investing into gold? And if so, which investment, which part of through the mutual fund route can you invest in gold? So that is part one of the conversation. Part two of the conversation. There's been so much talk about people wanting to keep their money in fixed deposits or fixed return instruments because equities have not returned good returns. What we're trying to do is try and give you a slightly extended view of what would happen if you were to choose an equity fund. And for simplicity, I think ELSS versus an EPF or a PPF, both of which also give you a tax benefit. So that's how we'll do the mutual fund show. Now, if you have queries, please do try and send them, and I'll try and take them as well. But let's first start the show with Vijay Mantri. Needs no introduction, really joins us on the mutual fund show a number of times and joins us today as well. Vijay, good having you. Thanks so much for joining in. Hope all is safe.
Yeah, hope all safe and hope all safe for you, your team, and all our audience.
Yeah, all our audience as well. That is very important. Vijay, I think the Indian audience would be very happy with what gold has done, right? Never mind what 1 or 2 days moment would be, but I think the last few months it's been a really good move. Now, I mean, I don't know how to predict the price movement of gold, but what I'm trying to understand from you is that how would an Indian investor use the mutual fund route to buy into gold, and whether it makes sense.
So it does make tremendous sense to invest in the gold through mutual fund route. And I'll give you, but before I do that, let me give just a little background how Indian has been investing in gold. One of the most favorite ways to invest in jewelry and then the coins and gold bar. Now, the challenge with physical gold is that physical gold, now we have close to 3% GST, and the price discovery is not very efficient. So, what price you see, which comes on various elect or media, that is not the price you end up buying gold at that level. So, there's always an inefficient discovery of price when it comes to buying physical gold. Second option is absolutely sovereign gold bond, and we'll talk a little bit about that if time permit. And third way to invest is invest through financial assets. So physical assets can be bought through financial assets, and that is the beauty of mutual fund. You could invest in mutual fund. You can invest in gold using mutual fund as a tool, and this provides far greater flexibility in form of investing the kind of money somebody want to invest, how much somebody want to invest, and also flexibility to take money out at very short notice. Somebody want to do that. So yes, the gold ETF does provide an excellent alternative to owning physical gold.
Hmm. Now let's try and put this into perspective. Now, physical gold, I don't think anybody's saying that physical gold is not a good investment product. I don't think Vijay meant that too. And Vijay, please correct me if I'm wrong. But there are challenges to that in that you have to store it, and there is a storage issue and the price discovery issue. Versus that maybe paper gold as we call it, is a great option. And I think everybody tells you that sovereign gold bonds are great options. But Vijay, just tell me before we dwell full tilt into paper gold versus physical gold, within this too as well, sovereign gold bonds versus the other options, I think liquidity becomes a key parameter.
Yes, liquidity does become key parameter in sovereign gold bond. You don't have anything for at least for first 5 years. You can't take money out, and after 5 years, only at the 6 month window you get the ability to exit. But whenever you exit, there's a capital gain tax incident at that time. So I think that is a challenge. And also, though it is listed, but I think in all these assets, the trading volumes are not very significant, so you don't get the instant liquidity which you traditionally associate with gold or most financial assets. So sovereign gold bond does provide 2.5% interest rate, and the long-term the capital gain is also tax-free if you hold till maturity. But it does have its own sorts of challenges which cannot be avoided.
Okay, so now let's get into investing into gold through mutual funds. What are the options? What is the better option?
See, when someone buy gold in physical form, people buy fixed quantity, not fixed amount. And it is very important to understand fixed quantity and fixed amount. When you buy fixed quantity, you end up spending more money when the prices are higher, and you spend less money when the prices are low. So, for instance, if somebody buying physical gold, invariably people will buy 1 gram, 2 gram, 5 gram, 10 gram, or whatever at regular frequency. So they spend not a fixed amount, but fixed quantity gold they buy. So if the gold is at 4,000 per 10 gram, they only spend 4,000 rupees. When the gold is at 50,000, they end up spending 50,000 for the 10-gram gold. But suppose you equalize that money, then perhaps at 4,000, you could have bought maybe 120 gram of gold at that time. And at 50,000, perhaps you'll just buy 10 gram. So the advantage of rupee cost averaging is far, far significant, which only can be used through mutual fund route. So we just gave some illustration, and I hope the graphics come on the screen when we talk about it. So if you look at physical gold, suppose somebody owning physical gold and somebody just bought say 10-gram physical gold every month for last 10, 12 months till 30th June, then somebody spent it close to 4 lakh 81,000 and the value of that money is close to 5 lakh 86,000. So IRR around 45%. If somebody has done the same thing for 3 years, then somebody would spend 12 lakh. So if you look at these numbers, if you look at 10-gram gold number, for 1 year, if somebody bought a physical gold, then IRR is 44.79%. Somebody bought physical gold for 3 years, 10 gram per month, then the IRR is 27.68%. And somebody has done for a 7 year, then IRR is just below 14%. If somebody just used the gold, physical gold, as the route to accumulate wealth. So this is the IRR number, and I'm also going to talk about absolute number. If somebody used the UTI Gold ETF, this is one of the oldest gold ETF in the country, then for 1 year, the IRR is 42.84%. For 3 years, the IRR is around 26%. And for 7 years, it is just below 13%. Though it looked lower, but if you look at an absolute term, if you've invested the same amount of money buying physical gold for 1 year, 3 year, and 7 year period, let me give some numbers. So in physical gold, after 1 year, your value would have been 5,86,440. But in gold ETF, the value would have been around 100 rupees more, 5,80,000. Though IRR looks a little lower, around 2%, but in absolute value, it is absolutely equal. And if you look at 7 year period, then in 7 year period, the IRR in gold ETF is around 13.94%, but total value is 41 lakh rupees. And in the gold ETF, the same amount would have grown to 46 lakh. So there's a 5 lakh more the investor has made in gold ETF because you are buying a fixed amount, not fixed quantity. So the average cost in case of fixed amount is always lesser than average cost in case of fixed quantity.
Vijay, but I could very well buy a fixed amount of physical gold as well, right? I mean, yes, people usually buy a fixed quantity, but I can buy them, right?
It's impossible to buy a fixed amount of gold because how are you going to go and tell a jeweler I want to buy jewelry worth I want to buy a
No,
bar?
don't they say that there is this thing called Cadbury wherein you get
So
small?
that
I
is
mean,
one
I can
case.
understand for small amounts,
Yeah,
yes,
that
for the
is a
large.
so it is a fixed
Okay,
quantity only one
fair point.
gram, 2 gram, 5 gram, 10 gram, 20 gram, and then 100 gram. That is Cadbury, but it is a
Yeah.
fixed quantity. This for viewer to understand why SIP always create wonder because in SIP you are buying through fixed amount. The
Yes.
average cost in the fixed amount is always lesser than average cost through fixed quantity. You could look at any other asset, any asset category, be it gold, be it equity mutual fund, or be look at debt mutual
Right.
fund. So in the same illustration, we explain that. But what is a better alternate even than gold ETF? Is very
Hmm.
interesting. A lot of people don't even talk about it. It is not been.
Yeah, Vijay, sorry, just before we get there, Viewers, just so that maybe you understood this, but I'm just repeating this because as I understood it, because a lot of you might have doubts like I do. I think what Vijay is trying to say is that if you correlate this to equity investing, right? When you're buying one share of, let's say, which is at 100 rupees, and you're investing 1,000 rupees, then you get 10 shares of 100 rupees each. But if the share were to go down to say 50 rupees, then you're getting 20 shares. So the number of shares coming up for the same amount, which is 1,000 rupees, is more, which is what happens in a gold ETF, because there's a fixed amount. So when gold prices move up, yes, you get less, but invariably when gold prices move down, and if you're invested for a longer period, then you get more quantity of gold. And that's why eventually at the current point of time, if you had been an SIP investor, you would have had more units of gold, and that's why you would have probably made more money. Vijay, am I clarifying it properly, or is there a mistake?
Bullseye. Bullseye.
Bullseye. Okay. Wait, I'm a student, so I'm just trying to understand if I got it right or not. But Vijay, what intrigued me was what you were saying, that there is a better way to invest in gold via the non-physical route. I thought ETFs was it. What else?
So if the gold does very well, then the gold mining company does much better. If the
Mm-hmm.
gold does bad, then the world mining company does worse. So they are much more volatile than the gold. But suppose you have a positive view about the gold, then the gold mining company does much better investment performance. And if you look at the same number, for instance, if you compare with gold and physical gold and gold ETF, and just put the world gold DS. There's only two products available in the Indian context, but it is the longest fund in the country. So if you look at this fund, the IRR compared to physical gold or gold ETF, it is 30% more for a 1 year period. For a 3 year period, the IRR is 7-8% more. And for a 7 year period, the IRR is 1% more. So let me give you an absolute number. In 1 year time, compared to physical gold in DSP World Gold, you have made around 60, 70, 80,000 rupees more. In a 3 year
Right.
period, you have made around 2 lakh rupees more, and in a 7 year period, you have made around 3, 4 compared to physical gold, you made 8, 9 lakh rupees more. So it is a far better alternate to go for owning gold. But keep in mind that this fund has always remained more volatile than the gold itself. So if you have a very positive view about the gold, go for gold DSP World Gold Fund. Suppose you have negative view about gold, then don't touch it. You should invest mostly when this fund deliver deep negative return. You're going to make fabulous money because ultimately gold prices does recover. In India, we have equity history of maybe 1980, but in Indian context, I am tracking gold prices from 1905. I have a chart which explains that gold in absolute term has delivered close to 8% CAGR for 95 years. Sorry, I'm tracking from 1925. So for a 1925 till 2020, gold has delivered above 8% CAGR for almost 95 years. A staggering number. But viewers, please keep in mind, there have been periods where for a 5 year, 7 year, even 10 year period, even 20 years period, in Indian context, gold has not delivered return. So when you're buying the gold, just looking at the current recent performance, also keep in mind after sharp rise in the prices, there come the period where the gold prices has not moved. So just keep that in a mind. It's just a sobering thought for the viewers to when they look at investing in this asset category.
Yeah, viewers, keep in mind, we are doing this not because we are saying, or not because there is an attempt to say that gold investing is great. Maybe it is, maybe it isn't. But the various ways to invest through. And keep in mind also, viewers, that the gold fund example that Vijay gave, the reason why the 1 year and the 3 year period returns are far more is because when gold prices are on upswing, these mining companies tend to do much better. Which is why if you see the 7 year period, yes, there is a difference, but not as stark a difference as the difference between the 1 year and the 3 year returns for DSP World Gold Fund versus the gold ETF or gold prices. So keep that at the back of your mind. But Vijay, this was interesting. So various options out there on the gold side. So in the mutual fund route, if indeed people want to invest via the mutual fund route, and it's convenient, it's easy, it's liquid, it works even during a lockdown. You can go out and still
Yes,
buy, which you would not have been able to
absolutely.
do for the
Physical
last
gold you
3 months.
can't buy. That's very true. That's very true. That's
Uh,
very true.
okay, Vijay, very interesting example. Thank you so much for that. Now, the part two of the show, Vijay. and that is this whole debate around the last 2 months people have taken money out, etc. So which is why this whole idea of trying to compare the safest product in the minds of investors versus an equity product which has got some equal characteristics. Take us through it.
So equity is, as we know, that is very volatile asset category. And one of my very affable, very nice friend told me that 30% of the gain accrue the people who go through the volatility. And I'm talking to that friend right now. So this is what happened in the equity. When returns are negative, people take money out. When the returns are positive, people invest more money. So what I've done here is very simple thing. We have compare PPF versus ELSS. People invest in PPF for a 15-year period plus. So what we have done is that we assume that an investor has invested 1,50,000 rupees per year on 1st April of every financial year for last 15 year or last 20 year. So for 15-year period, the investor has invested 15 multiplied by 1.5 lakh, around 22 lakh 50,000 rupees in PPF. The value of that is around 44 lakh rupees. If somebody's invested the same amount of money for a 20-year period, then in 20-year 50,000 rupees every year in form of SIP of 12,500 rupees for the last 15-year period and last 20-year period, then what has been the investment performance. So first we did SIP in the worst performing ELSS fund. And for 15-year, instead of 44 lakh 70,000 plus in PPF, the SIP in the worst performing fund for a 15-year period, the value is around 42 lakh rupees, so less than PPF. But for a 20-year period, even in the worst performing fund, the money is 88 lakh rupees compared to 76 lakh rupees in PPF. So even the worst performing ELSS has outperformed the PPF over a 20-year period. Then we looked at the SIP number in the average performing mutual fund of ELSS scheme and the best performing ELSS. So in average performing ELSS for a 15-year period, in place of around 44 lakh plus amount in public provident fund, amount which has accrued to the investor or accumulated in average performing ELS is around 48 lakh rupees and the best performing is around 52 lakh rupees for a 15-year period. But just look at 20-year number. Instead of 76 lakh rupees in public provident fund, the amount which investor was able to accumulate in average performing and the best performing ELSS is 2.5 to 3 times or a 20-year period. So yes, equity is a volatile asset category. PPF is very predictable, is very comforting. But if you're able to withstand the volatility and can invest for the long term, the kind of money ELSS is generated, the difference is not in percentile, but in multiples.
Vijay, past performance, just one disclaimer, right? Past performance will not be an indication of what the future would do, but we can safely say that the averages still tell you a story.
That's very true. And one of the biggest challenge with PPF is that when the interest rate get reset, it get reset on your entire accumulated amount. So maybe 20 years back, the PPF interest rate was 12%. But when the interest rate comes down, accumulation happen on the lower interest rate on the entire thing. But suppose you've done the same thing in GSEC fund. When the interest rate came down, you get gain in GSEC fund. So if you look at 20-year CAGR of GSEC fund in India, it is close to 10%. And PPF is a claim on the government. So it's a government of India security only. And now what we have seen, the PPF rates are now linked to GSEC rates. Now 10-year GSEC in India is right now 5.80 basis point. So you'll not be surprised if the PPF rate come down to 6.5% or 6 quarter in maybe 3 months or 6 months, maybe 1 year. It should have done now, but because I think the political reason the government may not be doing it. But yes, on all contractual government saving scheme, interest rate and return, the trajectory is absolutely downward.
Viewers, again, a disclaimer. I think if maybe your financial advisor or maybe some columnist would tell you that PPF is also as important a part in your portfolio. And that could well be true because I think it depends upon what kind of investor you are. For some, a lot of risk averse investors completely who depend on the year on year inflows, maybe this is not the right thing as well. Maybe it is, maybe it isn't. But what we are trying to do out here is to try and tell you that is there an equity option which over the long term gives you as much safety possibly with the same treatment as well, because the ELSS schemes also give you the tax saving that the PPF does. So keep that at the back of your mind. Vijay, just one final thing then. Let's assume people are convinced that that ELSS funds uh, are a better way to invest into the tax saving 1,50,000 rupees than a PPF is too. What kind of funds that can they go into? Because there's a plethora of funds available. Again, past performance may not be the true measure of what will happen in the future, but you've analyzed so many funds over such a long time. Which are the ones that have done really well over a long time? And again, what you'd say need not mean that the others are bad. I'm just trying to figure out what do you think has done exceptionally well over a period, not just in terms of returns, but in terms of stability of performance, etc., etc.
So there are many funds in the market, and one should not take fund of what we are saying immediately, because one also need to see whether the similar kind of fund is there in the customer portfolio in the large cap, small cap, and other category as well. So don't take my advice as the fitment into your financial plan, but you need to consult your own financial advisor. So we look at Mirai Tech Saver has done well, Invesco has done well, ICICI Prudential Fund has done well, Franklin Templeton, now the performance is under pressure, but over a long period of time has done well. SBI Funds has done well, Birla Fund has done well, L&T Fund has done well. So there are at least 8-9 funds which has delivered a very decent investment performance over a longer period of time. But I would like to, as you rightly mentioned, Niraj, EPF is a very straight line. ELS is not a very straight line. So I'll just give one simple illustration. If you invested 1.5 lakh rupees in PPF and you look at the performance after 1 year, the trajectory is always upward. So 1,50,000 might have become 1,60,000 or whatever is the number. But in a worst case scenario, the ELS's number has come down from 1,50,000 to 75,000 and below. Even for a 3-year period, I have examined the performance. In a 3-year period, 4,50,000 invested in PPF has become, say, 5,50,000 for argument's sake. In this ELSS, the same 4.5 lakh, even after 3 years, is just below 4 lakh rupees or maybe 3.5 lakh rupees. So you have seen the PPF and ELSS gap over a 3-year period. In ELSS, after 3 years, in the worst case scenario, the money is 2 lakh lower than PPF, and you get worried that what the hell I've done. And when you do this path, this will happen. The ELSS for a 3 to 5 year period will underperform PPF to the extent of 2 to 3 lakh rupees. But we are not talking about 2 to 3 lakh rupees gap. If you look at the historic performance, we're talking about a gap of 1.5 crore rupees. So audience needs to understand, with little bit of volatility of 3 lakh, 4 lakh, maybe 5 lakh rupees over a 5 to 7 year period. But the longer time period, the gap is really, really staggering. So keep that in mind.
If you are indeed investing for the long term, I would urge you to at least look at these statistics before you go out and make a choice. Again, nobody's bad mouthing PPF. As I said, a lot of people would say that PPF is a must-have too, but it pays to look at numbers because individual people have individual opinions. Data always wins. Keep that in the back of your mind. Yeah. Anything else, Vijay, that I've missed out asking you on this comparison?
No, I think I just did a comparison for 20 years, but suppose you take data for 23, 24 years, then the numbers are really, really staggering. I'm tempted to tell the number. So I did a study of 1 year back. I could not update that number because of lockdown. My team is not coming to office regularly. So I did one particular fund which was launched in 1996. Total amount invested in PPF for 34 lakh rupees has become, say, 1 crore 6 lakh rupees. In that fund, SIP numbers of 24 years, same amount invested, the number is close to 10 crore. But again, with the short period, extreme volatility, underperformance over a 5-year period, audience just need to keep in mind, PPF provides stability, mental peace. Equity can create some volatility in the portfolio. If you're not comfortable with that kind of volatility over a 1 to 3 years period, and even 5-year period, then PPF is a better option for you. And if you're comfortable with the volatility, then nobody can beat ELSS in the tax saving products.
Great. Vijay, I hope people understand this properly, but thank you so much for bringing this match to us and these products too. Lovely having you. Thanks much for taking the time out and being with us today.
Thank you.
And viewers, stay safe and thanks for tuning into the Mutual Fund Show.